What if I told you the richest people on Earth are quietly heading for the exits, and they're literally all doing it at the exact same time? I'm not talking about blind panic here. I'm talking about cold, calculated strategy. The last 90 days, we're seeing CEOs, massive hedge funds, and private family offices secretly selling off their assets. What if the billionaires are quietly leaving? I want you to really think deeply about the implications of that for a second. The smart money, we're talking the investors with the most insider knowledge, the deepest pockets, and the best financial models on the planet, they're actively abandoning things that you and I probably still think of as completely safe investment. Let's dive into this explainer because the harsh reality is this. If you don't see why they're selling right now, you could easily get caught holding the bag in 2026. Today, we're going to break down exactly what's happening behind closed doors. We'll unravel the data together, and most importantly, we're going to figure out what this massive wealth shift actually means for your own money. 1. 3 major red flags. To really understand this billionaire exodus, we first got to look at the hard data, because the numbers simply do not lie. $270 billion. Yeah, you heard that right. Cash is officially king again. That massive number represents Berkshire Hathaway's recently reported holdings in pure cash and treasury bills. That's the highest cash pile in the company's entire history. To put that into perspective, when Warren Buffett, arguably the greatest investor of our time, decides to just sit on $270 billion in cash, it means he's looking at the entire market and seeing absolutely nothing worth buying. And look, it's not just the stock market giants pulling back, negative 50%. The IPO market, where new companies first list their shares for the public to buy, it's practically frozen solid right now. New company listings are down almost 50% compared to last year. This clearly shows us that the smart money is completely freezing their funding of risky startups. They aren't placing bets anymore. They're just waiting on the sideline. Then, there's our third red flag, $12 trillion. That is the terrifying amount of corporate debt currently piled up by U.S. companies. And here's exactly why this specific number should make you sit up and pay attention. A massive portion of that $12 trillion needs to be refinanced in the very near future, like the next 12 months near. And the kicker? It's going to have to be refinanced at much, much higher interest rates. That is a massive problem just looming right over corporate profit. Section 2, why smart money runs. So we've got cash piling up in record numbers. New deals stopping in their tracks, and corporate debt getting incredibly expensive. But we really need to analyze the motives behind this silent exit. Now, what's really interesting about this comparison is looking at the 1999 dot-com bubble versus today's AI hype cycle. Look, artificial intelligence is absolutely real, for sure, and it's totally transformative. But right now, almost every single company with just the letters AI attached to its name is trading at 40 to 50 times their earnings. It feels incredibly similar to 1999. The billionaires selling off today, they're the exact same people who made their fortunes navigating that dot-com bubble. They recognize the pattern, and they know exactly how this story ends. It builds into a much broader economic issue, the rate problem. See, the Federal Reserve kept interest rates high for 2 full years. Now everyone in the market is expecting rate cuts. But here's the secret the wealthy know that most people don't. Rate cuts don't usually happen when the economy is perfectly healthy. No, they usually happen because something in the financial system is actually breaking. Smart investors do not wait for the economy to break before taking action. They position themselves safely long before the cracks even begin. And then, well, we have this massive hidden threat, the private credit explosion. This is a complex $2 trillion shadow market made up entirely of private loans, and almost nobody in the mainstream is really talking about it. It's highly interconnected, almost like a giant puzzle. If just 1 or 2 big funds within this space were to default, it could trigger a devastating chain reaction across the entire financial system. Institutional investors can absolutely see this shadow market looming, and they're desperately reducing their risk exposure right now just to avoid getting caught in the inevitable fallout. The crucial point is this. They're not bearish on America. They're bearish on valuations at these prices. The billionaires pulling their money out? They are not betting against the country or its long-term future. Not at all. They simply refuse to overpay for assets in an incredibly hyped-up, overpriced market environment. 3. What they're buying instead. Okay, so if the smartest money in the world is selling off tech and risky startups, we need to shift our focus and follow the money. Here's exactly what their new defensive strategy looks like. First up, they're moving into short-term U.S. treasuries. Why? Because they offer a solid 5% return with almost zero risk. I mean, it's boring, sure, but it is incredibly safe. Next, they're moving into defensive stocks. Think healthcare, utilities, consumer staples. These are the basic necessities people still have to buy even during a severe recession, so they're highly resilient. And finally, Cash. Yes, just pure cash. Because in a crash, cash isn't just a safety net, it provides massive buying power. When a market drop inevitably lowers prices, holding cash is literally the only thing that lets you swoop in and purchase incredible assets at a massive discount. So they aren't going to zero, they're strategically retreating to safety to weather the coming storm. Section 4. Your personal action plan. So what does this all mean for you? Look, I want to be perfectly clear right here. Selling absolutely everything you own and stuffing your money under a mattress, that's a bad idea. Panic is never a financial strategy. But making strategic, measured moves right now, that is absolutely essential for protecting your own financial future. And this brilliantly illustrates 3 exact moves you can copy right now to protect your personal portfolio. Number 1, check your risk. Take a hard, honest look at your investments. If 80% of your portfolio is tied up in tech and growth stocks, it's time to rebalance. Number 2, build a cash position. You definitely don't need $270 billion like Warren Buffett, but keeping even 10 to 15% in pure cash gives you vital options if the market dips. And number 3, stop chasing hype. If an asset just shot up 200% in 6 months, but the underlying company has 0 actual profit, you really need to stop and ask yourself why the billionaires aren't buying. I want to leave you with the overarching lesson of this explainer. The smartest money isn't predicting a crash, they're preparing for one. Preparation is the ultimate wealth-building strategy. You don't need a crystal ball to be successful. You really just need a solid, data-driven, defensive game plan. Which leads me to a final provocative question for you to consider as we wrap up. Are you seeing these same warning signs, or am I overreacting? I want you to take a look at your own financial surroundings. Look at the market in your area and think deeply about the valuations of the assets you hold. Keep analyzing the data, stay curious, and most importantly, stay prepared.